In this presentation, we will take a look at tax software to consider tax rates and how taxes are calculated both in practice and in theory. One of the best ways to get a good idea of what is happening is just to put the information into the tax software and test it out. We are using, you'll recall, Lacerte tax software. It's a professional tax software. It'll make it easy to do the data input, but any tax software will help you get a better intuition into how things are working and how you can work things better. So we're in our tax software. Here's our 1040 for our test client, James Smith. We're going to go back to our trusty data input screen. We're just going to simply add a W-2 wages just to test it out and say, well, what would happen if we had W-2 wages of 40,000? So we're going to say 40,000 miscellaneous job. Let's just see what calculates within the tax software. If we go back to the tax software, then back to the forms, then we scroll down to the first page of the 1040. We'll get into more detail about the components of the 1040 in a future presentation. But at this point, we just want to consider what the rate will be in the calculation on it. You'll note that we have the 40,000 up top in the income area. Now that's not what we're going to be applying the tax to, however, because we're going to have to reduce it by the deductions. The deduction here, the only one we're going to take a look at to keep it simple at this point is the standard deduction, bringing the taxable income down to the $27,800. So when we consider these types of rates, the rates that we're going to be talking about, remember that we're not really talking about gross income. That's another kind of complication that you got to basically understand in terms of terminology when people are talking and when you're discussing this with yourself and with clients. We're talking about the taxable income. So now we're saying the taxable income in this example is the $27,800. We'll talk more about how to get to this point in a future presentation, but we want to consider how the rates are applied at this time. Now note that we can double check this number, oftentimes will, with an outside worksheet. I can easily use an outside worksheet such as Excel, which is done with a tax formula. We'll go through this in detail in future presentations as well, and simply plug in the calculation to get to the taxable income. I could say, okay, there's the 40,000, that makes sense. I'm going to say here's the 12,000 standard deduction related to single or married filing separately. That would result in the taxable income of the $27,800. Check, that looks good. And notice that's basically where I'm stopping in terms of the verification. I'm not going to the tax rate because it's not a flat tax. It's complicated to calculate the tax rate. Oftentimes we'll be depending on the tax software to do that. So once we get down to the taxable income, we're going to say, all right, what's the tax calculation? And we'll use the software to help us out. In this case, that tax calculation being on line 12A, 3,145. So there's the 3,145 that was calculated for us by the software. We can go back into our Excel worksheet and say, all right, here's the 3,145, and then think about kind of the other half of the tax worksheet, which would be, are there any credits and other taxes, and what are the payments that we have in it, which we'll talk about in future presentations. So we verify this number, and then we kind of depend on the software oftentimes. Generally, most practitioners will, when they put the data input in, to get that calculation. However, when we communicate with the client, we got to know what that calculation is doing, and we want to have a good understanding of what it's doing, and then how can we explain what it's doing. So typically this information is going to be coming from the tax tables. So tax tables that are generated. Now the tax tables, we only have the 2018 at this time. So if I was to go back to the Lacerte software, back up top, and say, all right, well, how is it getting this number? How is it going from that taxable income, 27,800, and getting that 3,000 or so in tax on it? Well, we've got the tax tables that we can consider. If we go to the irs.gov website, we can take a look at the tax tables. We're currently only going to see the 2018, which is a year old because the 19 is not there yet. So this is just going to be an example of that. We're looking up the instructions for Form 1040, tax forms, and we have the tax tables here. Again, 2018, we're actually working in 2019 in terms of the actual tax forms at this time, which are in the draft format. Then if we go to the tables, we get this very ugly long list of tables, right? And what we're going to do with this table is we could then say, okay, here's the range that we have of taxable income. Are we single, married filing jointly, married filing separate, head of household, and then look at the range and the related tax to it. We're not looking about gross income here. We're not looking at the 40,000. We're trying to find the 27,800. So if we go to our tables then and look for that 27,800, and we're looking in the single section, we'd have to say, okay, here we are down here. We're at the 27,750 to 20,800, or the 20,800 to the 27,850. So that's going to be that 3,143. If we go back, because that's in the single column, so we're in the single column, so we're within this range in the single column. If we go back to Intuit, 27,800, page 2, there's that 3,145. Now again, it may not be exact because we're looking at the prior year's tax tables, but it's pretty close. So then the question is, okay, what does that tell us? If we're sitting down with a client and they say, all right, here's the tax that you owe, we can tell them this is your gross income that was put in place, the 40,000 after deductions. You had taxable income of the 27,800, and then the software calculated that 3,145. And they're going to ask, well, how did they come up with that? Most of people that we're talking to aren't going to get any added value. If we then pull out the tax table and say, well, Lacerte is then going through this tax table and finding this range of numbers, and basically based on your filing status, just spitting out this number. That's not very useful because it doesn't tell the client how these tables are obviously generated from some kind of system. And what the taxpayer wants to know is like, well, what's my average tax that we're paying? And what kind of projections, or what could I expect if there's changes? So although this is basically the way most of the time the tax will be calculated, it's really not that useful to tell this to someone else or show this. Most people, this is just going to make their eyes roll over if you pull out these tax tables and pull them out and show them that. What you can show them is the tax brackets. So it makes a lot more sense then to show them something like this, which would be the tax brackets, which would give us an idea of those ranges basically that they would fall in. This is going to be easier to absorb. Even this is probably over and above what most clients want to know. And so what you're going to basically want to start off with is the concept of the marginal tax and the average tax. Yes, we use a progressive tax system. You're going to be taxed at multiple rates. Here's basically your marginal tax. Here's your average tax. If you want more information than that, break out this and say, here's basically the ranges that we would have, and where you kind of fall into basically the ranges based on your marital status. And it would take a very, unusual client that would want more information than that and actually look at the tax tables and look into the tax tables type of information, because it doesn't really add any more value that they would want to see typically. Now, most software will give you those added two numbers of basically the average tax and the marginal tax. And you can get those in this software if we go to the tax summary, which will give us more of a formula type basis. It'll be similar to what we're doing here in our Excel worksheet. And it'll give you just basically a more of a quick breakdown, and will typically calculate in some way, shape, or form the marginal tax and the effective tax in this case, which is basically the average tax. So what is that? Notice that average tax then is just basically taking the taxable amount, 3,145, and dividing by the taxable income, not the gross wages, but the taxable income. So that's going to be fairly easy to calculate. The marginal tax is the top bracket. That's going to be the top bracket that they are in. So those two numbers will typically be calculated for you. You want to be able to know when to use those two numbers. And so now we can just do some experimentation and see what would happen if we change some data, some simple data, and see what would happen. And this would be useful, and this is the kind of thing that you would typically do if there's going to be like projections. What's going to happen next year? What are you going to do next year? What if your income goes up by this? What's going to happen to it? We can go back easily in software such as this and say, okay, well, what would happen if we had 100,000 and we're still filing as single? We're going to go back to the forms, and then we can go to the 1040. And we say, all right, there's going to be the 100,000. There's we're still deducting the standard deduction at this point of the 12,200. We'll get into more detail on that in future presentations. Here's the 87,800. Again, in our tax worksheet, we could say, well, can I kind of verify that in the tax worksheet? I can get down to that verification. I can say, well, there was 100,000 in their wages, and then we're going to subtract the standard deduction. I can kind of calculate that out pretty easily in just a formula type of basis. And then I don't know what the what the actual tax will be, then we'll say, all right, so that's 87,800. I verified the taxable income, verified the 87,800. Let's go to page 2, which will actually calculate the tax at 15,253. Go back to our sheet here. We got the 15,253, and then we can think about the second part of our worksheet, and then think about the credits and any other taxes and tax payments, which we'll consider in future presentations. So that's how we might verify it externally with a formula on it. So there's our 15,253. If we go back to our tax summary, we could say what happens to the tax summary. We've got the marginal tax rate at 24,009, at 24,000 now, and the effective tax rate at the 24,017. Notice the marginal tax rate is always higher than the effective tax rate because that's the highest tax bracket that they're going to be in. The effective tax rate is going to be the average tax rate. So this is the average tax that they pay. Some of their dollars being taxed at more than that. Some of that then is less than that. So client asks, how much tax am I paying? We have to say, well, your gross wages were 100,000. After deductions, you had taxable wages, taxable income, 87,800. If we consider that taxable income, 87,800, not the gross wages, and we go to the tax summary, we can then say that the average tax rate that you have, effective tax rate, is 17.4, which we can calculate in our Excel worksheet pretty easily, right? There's our 17, which is simply taking the tax that was paid, which is the the tax that was paid, which was the 15,253 divided by the 87,800. And so there's the 17.3, about 17. So that's going to be something that we can easily calculate for them. However, we don't want to use that for projections. If they then say next year, hey, look, I think I'm going to make another 50,000. How much more am I going to owe next year? If there's no change in the actual tax rates, we say, okay, you're going to make another 50,000, and your average tax rate, this would be an error. It's 0.174%, 17.4%. It would be wrong to say 88,700. They're gonna make wrong calculations on that because they're in that tax bracket, and you need to then use the marginal tax rate. Oh, you're gonna make another 50,000 next year? Well, that's your average tax rate. Your highest tax bracket, the next dollar that you will be taxed on in your marginal, using marginal taxation, is going to be the 50,000 times you're at 24%, and you would have to consider if it's going to break them into another tax bracket, a higher tax bracket than that, and you've got, not 24, 0.24%, right? So you'd have to use the marginal tax bracket to consider what the projections will be in the future. Now, if we look at this in terms of our tables, you'll recall our table here before, and we're saying we have a single taxpayer, and they made, if we think about their taxable income now, is 87,800. 87,800 is going to be between this bracket. So their highest rate, according to this table, is the 24. That's their marginal tax rate. But they have been taxed at all of these rates up to that. That's just what their last dollar was. Therefore, the average is somewhere in here. Now, we can consider this table in terms of, we've been looking at single. Let's say, well, what if we had a married individual that was earning the 100,000 between the two of them in a married couple? So we'll go back to our trusty data input screen. We're going to change from singled to married filing jointly. So married filing joint, and then we've got Jane, and we're gonna keep it at that. If we then go back to our return, there's the 100,000. The change here happening is now we have a standard deduction, which we'll talk more about in future presentations, is out 24,400, which brings the taxable income down to 75,600. So if I then go back into our Excel worksheet, we can verify that. I could say, well, there's the 100,000 again that was made. Now their standard deduction, if they're taking the standard, we'll talk more about that later, is 24. Therefore, I can verify the 75,600. Then I'm somewhat reliant on the tax software. So I go back over here and say, all right, check 75,600. How much tax is going to be calculated on that? Page 2, tax calculated at this point, 8,687. So I'm going to say, all right, 8,687. I can think of the average tax rate then being at 11%. So that's not the actual tax rate because it's a progressive tax system, but the average. So how can we communicate this with the client then? We're going to say, well, how much tax do we pay? We can say, we can actually go to the tax summary. Let's look at it in the formula. You earned 100,000. Then you had deductions. In this case, we're only taking the standard deduction at this point, keeping it simple. That brings it down to 75,600. So your taxable income is 75,600. You actually paid tax of 8,687. The average tax on that is 11.5%, which is just dividing out the 8,000, right? You could just divide that out. So that's going to be the 8,687 divided by your 75,600 taxable income, not your gross income. We're talking about your taxable income. We're not talking about the 100,000, but the taxable income after the deductions of the 75,600. Then you have the highest tax bracket, which is now at the 12%. And if we consider our little worksheet here, we're at married filing joint. So if we're considering the married filing joint, we were at taxable income of 75,600. 75,600 falls in here. And so our top tax bracket is the 12%. 12% tax bracket is the top bracket there. Again, if we change the wages then, if I go back over and say, all right, let's go back to the detail. We go back to the income. And let's just say that now we had 150,000. 150,000 back to the forms. So that's going to be the gross wages, 150,000. We're taking out the 24,400 for the standard deduction, bringing it down to the 125,600. So now the tax would be 19,345, 19,345. So if we think about that in terms of the table, 125,600, 125,600 here is going to be between this column. So we should be at the 22 marginal tax bracket. So if we scroll back down, we're going to say at the 22 marginal tax bracket and the 15 average or effective tax. So the bottom line, when you talk to people, the things you want to keep different is we're talking about gross wages and we're talking about the taxable wages. When we talk about these tax rates, we're typically applying them, marginal tax rate, average tax rate, as we calculate them to the taxable income, which isn't what was actually earned. In this case, of course, they earned the 150. The taxable income is the 125.6. So you gotta keep that clear if you're talking to someone about taxes or how much they paid, and keep that first clear. And then you got to keep clear that there's a progressive tax system that we can simplify down in terms of an average and marginal tax rate, using those terms in association with whatever goal that we're trying to get to. So we want to use those basically averages, those numbers, to achieve whatever goal. Is it a projection we're talking about? Are we just debating whether or not taxes are fair or not? Whatever it is, we need to be able to use these averages and these numbers in a way that's appropriate for whatever objective we have.